Hello dear students, this is Professor Aagam Dalal from JK classes. Today we are here to discuss each and every amendments regarding Inter CA Direct Tax May 25 attempt. This amendments will be applicable from May 25 and onwards. That is, this will be applicable to September 25 attempt also, January 26 attempt also. Now please understand, this video is particularly for those students who could not clear the exam in January 2025 attempt. Those students who are a regular student of either May 25 batch or September 25 batch, or as the case may be January 26 batch. These amendments which I'm going to discuss are already done in your classroom. There is no need to see the lecture because there is no further amendments. This particular video is for those students who could not clear January 2025 attempt. Now please understand, those students whose result was unsuccessful, it is just a comma, not a full stop. Don't have any kind of negativity. You all will clear the examination in this May 2025 attempt for sure. And with that positivity, without wasting a single minute of yours, let us start this amendment lecture. There are so many amendments. I will try to cover each and every amendment in the very simple format over here with some examples whenever needed. First of all, please understand, when you have studied your January 25 attempt, your Finance Act was Finance Act 2023. But now in May 2025 attempt, your Finance Act, that is budget which will be applicable to you, is Finance Act 2024 number 1, Finance Act 2024 number 2. There are two budget because there was the election during the year. So there are two budget applicable. One is number 1, one is number 2. The budget number 1 issued on 1st February 2024. Budget number 2 issued on 23rd July 2024. Both these dates you have to remember. 1st February 24, 23rd July 2024. Which previous year is applicable for your exam? Previous year 24-25, for which the relevant assessment year is 25-26. So, okay, previous year 24-25, assessment year 25-26. These 2 years are applicable to you. Chapter by chapter, we are going to see which amendments are applicable. Let us begin with the very first chapter, that is Introduction to Direct Tax, that is basic concept. Now in the basic concept, please understand there is no change so far as tax rates are concerned, old regime. The tax rate of old regime are all same. Either 2,50,000 ka basic exemption limit, 3 lakh ka basic exemption limit, 5 lakh ka basic exemption limit, that all remains same. But there is a drastic change in the tax rate of 115 BAC, that is our default tax regime. The tax rate of default tax regimes have been changed. It has been reduced further to attract more taxpayer. So what are the tax rate applicable for previous year 24-25? If your total income is up to 3 lakh, either below 60, above 80, non-resident, for all. If you are individual, HUF, AOP, BOI, AJP. Now even this 3% can also claim 115 BAC. They can also go for 115 BAC. So if you are individual, HUF, AOP, BOI, AJP, and you are going for default tax regime, up to 3 lakh there will be no tax. 3 lakh to 7 lakh it will be 5%. 7 lakh to 10 lakh it will be 10%. 10 lakh to 12 lakh it will be 15%. 12 lakh to 15 lakh it will be 20%. Above 15 lakh it will be 30%. So when you have studied 115 BAC, it must be 3 lakh to 6 lakh. Now it has went from 3 lakh to 7 lakh. And further rates are changed accordingly. So let's revise it once again. Up to 3 lakh 0, 3 lakh to 7 lakh 5%, 7 lakh to 10 lakh 10%, 10 lakh to 12 lakh 15%, 12 lakh to 15 lakh 20%, above 15 lakh 30%. Please understand one more point over here. There is a small technique. If your total income is more than 15 lakh, you are following 115 BAC. Can I say up to 15 lakh, the tax is fixed 1,40,000. And whatever is the income over and above 15 lakh, on that you have to apply 30% tax. So these are the changes in 115 BAC. There are further more changes also, which I will discuss in the further chapters. One more change in this first chapter particularly. To a foreign company, now tax rate will be 35% instead of 40%. So earlier a foreign company was taxable at the rate of 40%. Now the tax rate has been reduced and now it is 35%. Acha, tell me, what is the tax rate for a domestic company? Can I say for a domestic company, general tax is 30%. However, if your turnover of preceding to preceding year, now your previous year is 24-25, so preceding to preceding year will become 22-23. If turnover of 22-23 is less than or equal to 400 crore, the tax rate will become 25%. So what is the change over here? Earlier you were supposed to see the base of 21-22, but now you are supposed to see the base of 22-23. The foreign company tax rate is reduced to 35%. There is no change in the taxation of rebate. So the rebate also earlier 87A. If you follow old regime and your total income is up to rupees 5 lakh, rebate is basic tax or 12,500, whichever is lower. If you follow 115 BAC, the rebate is available if your total income is up to rupees 7 lakh. And what is the rebate? Basic tax for 25,000, whichever is lower. That thing remains as it is. There is no change in that. Marginal relief is available for rebate in 115 BAC. Even that thing also remains as it is. Surcharge also remains as it is. There is no further change. Only these changes which I have described. So these changes will be whole and sole changes. Apart from this PDF, you are supposed to see nothing. All the changes I have covered over here. This PDF which I am using in this particular video is available in the description of this YouTube video. Now, residential status and scope of income, there is no change at all. Income from house property, there is no change at all. Income from salary, no change at all except section 16 clause 1A. What is the standard deduction? 50,000 or gross salary, whichever is lower. Mainly 50,000. To attract the salaried people to come to 115 BAC. Now what they have said, if you follow 115 BAC, standard deduction is available. That is 16 clause 1A is available. Not just 50,000. Now it will be 75,000. See, when you studied in 115 BAC, 16 clause 1A was available, but it was only 50,000. Now they have increased to 75,000. So please remember, if you follow old regime, 50,000. If you follow 115 BAC, standard deduction will increase to 75,000. But can I say, if you follow 115 BAC, you cannot claim 16 clause 2, that is entertainment allowance to government employee, not allowed. 16 clause 3, professional tax, not allowed. That thing remain as it is. There is no further changes. Only one change, as I discussed. Now, so far as your biggest chapter, profit and gain from business or profession is concerned, which in short we call it PGBP, few changes are there. All the changes are important for you. The very first change. Now, though the change is given in PGBP, it is also affecting income from house property. There is a section called basis of charge, section 28. In section 28, there has been some explanations given, which says that if your business is a speculative business, you have to compute the income of that business separately. You can't merge it with non-speculative. Now, below all this explanation, one more explanation is added, explanation 3. And what this explanation says that income from letting out residential house or part thereof by the owner will always be called as income from house property and it will never be taxable under PGBP. Now, what does it mean? Let me tell you the whole and sole things which are applicable to this. This generally I discuss in income from house property chapter. You need to see what is your main business. If your business, you are a constructor, your business is to sell the asset. Your business is to sell the property. You construct the same, you sell the same. That is your business. And if during that particular period, you have given the property on a rental basis to somebody, that rent will be called as income from house property because giving the property on rent is not your business. Can I say business is to sell the property? So if a builder let out the property for a temporary period, the rental income will go in income from house property because renting the property is not his business. But if you're in your memorandum, your object, your one of the business is to give the properties on rent. So renting is also one of your business. Then earlier I would have said that if your main business is to give the properties on rent, it is PGBP. That rental income will go under PGBP. But now there is one change over here. If your business is to give the properties on a rental basis to somebody, then see which kind of property you are giving it on a rent. Either it is a commercial property or it is a residential property. If it is a commercial property, then that rental income will go under PGBP. If it is a residential property, then that rental income, even though it is your business, it will go under income from house property, meaning thereby you cannot deduct each and every expense against that rental income. You can claim only 30% standard deduction. To reduce the deduction, government has done this amendment. So the things are clear. This chart is pretty clear to all of you. You can note down it. If your business is to sell the property, rent will go under income from house property. If your business is to give the properties on a rental basis, and if it is a commercial property, it will go under PGBP. If it is a residential property, it will go under the head house property. Are you understanding this, people? Then there is one amendment directly in section 36, other deduction. Generally, I give the entire table that there are some 10 to 12 deductions in inter-CA level at least, which are given under section 36. And one of the deduction is when your employer contribute to NPS account of employee. So for employer, can I say it is a business expenditure and hence it is allowed as a deduction. So an employer contribute to the national pension scheme of employee, deduction is available maximum up to 10% of salary of employee. And what is the meaning of salary for that purpose? Basic plus DA forming part of retirement benefit, that is DA percentage. Now what is the amendment over here? Now if the employer contribute to the NPS of employee, deduction is available up to 14% of salary. So they have increased the deduction by further 4%. Now even though old regime, even though 115 BAC, for PGBP chapter, this deduction is now fixed at 14% of salary. So even though employer follow old regime, still he can claim this 14%. The corresponding change has also been done in 80 CCD subsection 2, which deduction which is available to employee. But that corresponding change, which we will see further, that is applicable only if you follow 115 BAC. But so far as employer is concerned, even though old regime, even though 115 BAC, the deduction is fixed 14% of salary. Now it is not 10% of salary. Are you understanding this? Then there is one small amendment which is not that material. Section 37, subsection 1. Can you say it is a general deduction? If the expense is not covered by section 30 to 36, it is not in personal in the nature, it is not capital in the nature, and if it has been incurred during the year related to business, you can claim deduction of the same. That is the first explanation. If that expense is done which is an offense under any act, disallowed, penalty, etc., disallowed. Second explanation, CSR expense as per Companies Act 2013, disallowed. Explanation 3, which said that whatever we discussed in explanation 1 regarding offense, that can be in India, that can be outside India. If the recipient cannot legally accept the amount, for payer also it will be disallowed. Compounding of the offense, that amount will also be disallowed. Now, one more explanation is added to this particular section, explanation 4. And what this explanation says, any expense done to settle the proceedings initiated in relation to contravention under such laws as prescribed will not be allowed as a deduction. So there will be some list which they will issue later on. If you have done some offenses under this act, you don't want punishment, you can pay certain amount as a settlement. And whatever you will be paying as a settlement, that also will be disallowed. That is what said by explanation 4. But the list of the laws are not yet prescribed. It is not in the syllabus as of now. So according to me, you can safely ignore this so far as exam is concerned. The fourth one, and this is important for you people, a huge amendment. And what is that amendment all about? If a partnership firm is giving remuneration to partner, interest to partner, that is allowed as a deduction to the firm. and that will be taxable to the partner under PGBP. How much deduction is allowed to the partnership firm? For the interest which is paid to the partner either on a capital or on a loan, up to 12% per annum. Up to 12% per annum. And if it is a remuneration, then it depends on the word called book profit. What is the simple meaning of book profit? PGBP income of the firm before deducting remuneration. So you take your net profit as per P&L, you do all the adjustment from section 28 to 44 DB. You deduct interest also up to 12% per annum. And whatever is the balance amount before deducting remuneration is called as book profit. And based on that book profit, a certain limit is there. Up to that limit, remuneration is allowed. Earlier, that limit was if your book profit is up to 3 lakh, then the remuneration will be 90% of the book profit or 2,70,000, whichever is lower. And whatever is the balance book profit of that 60%. Now, sorry, up to 3 lakh if your book profit is there, 90% of the book profit or 1,50,000, whichever is higher. And on the balance book profit 60%. That was the provision earlier. Now what is the change? The limits are doubled. So partnership firm is getting benefits over here because the deduction limit has been doubled. Now if the book profit of the partnership firm is up to rupees 6 lakh, then what will be the maximum remuneration that is allowed? 90% of the book profit or rupees 3 lakh, whichever is higher. Earlier this limit was 3 lakh, now it has been increased to 6 lakh. Earlier this minimum deduction limit was 1,50,000, now it has been increased to rupees 3 lakh. So if your book profit is up to 6 lakh, the remuneration that you can give is 90% of the book profit or 3 lakh, whichever is higher, combinedly for all the partners. And whatever is the balance book profit, of that balance you have to apply 60%. And finally, whatever is your actual remuneration, whichever is lower. That is okay. So the limit has been increased, the limit has been doubled. Now, the particular reason for which I have come up with this video is this chapter. N number of students on a daily basis asking so many doubts regarding amendments of capital gain. Though I have shared the notes with them, though I have shared the summary with them, but many of them are yet not able to understand each and every corner of these amendments because the amendments are very crucial. And these doubts led me to shoot this video and upload the same. Capital gain chapter. Let me tell you, the second budget which came on 23rd July 2024, that particular budget contains all this amendment. The first budget which came on 1st February 2024 contains not a single amendment. Why? Because it was a temporary budget. Now, but 23rd July 24 ka budget has so many amendments, and I to call this budget as a capital gain budget. Because highest amendments are done in capital gain chapter. Your entire chapter has been changed approximately. Don't worry at all, we are going to discuss each and every amendments which are applicable over here. First of all, we are discussing about capital gain. One by one, we'll discuss each and everything. First of all, the very first amendment is in section 47 clause 3. Then what is section 47 clause 3? If any transfer by way of gift, will or irrevocable trust, it will not be regarded as a transfer. However, if ESOP is given under gift or irrevocable trust, it will be regarded as a transfer. Now, what is the amendment? From financial year 24-25, if an individual or HUF transfer any asset by way of gift, will or irrevocable trust, it will not be regarded as a transfer. This particular clause has been replaced. Now, what is the difference? First difference. Earlier, this exemption of capital gain was available to a firm also, company also, AOP also, BOI also, to all the person. So if a company give any capital asset by way of gift, it is not regarded as a transfer for the company. But now from financial year 24-25, what they have assumed, a gift, will or irrevocable trust can only be done by individual or HUF. Exemption is available only to individual and HUF. So what if I am a company, now I am giving a gift of a capital asset to somebody, it will be regarded as a transfer. I am supposed to pay capital gain tax. And the fair market value of that capital asset on the date of transfer will become full value of consideration as per section 50D, because the FVC is not determinable. So here the exemption is now restricted to individual or HUF. And the ESOP wala proviso is also deleted. So the benefit is, now even if you give ESOP as a gift to somebody, it is not regarded as a transfer, which was earlier regarded as a transfer. So if you give any capital asset including ESOP, the gift will irrevocable trust. And if you, that means the person who is giving a gift, is an individual or HUF, then it will not be regarded as a transfer. So any transfer of a capital asset by individual or HUF under a gift or will or irrevocable trust is not a transfer. Earlier, this clause was applicable for all. Achha, now transfer of ESOP is also not treated as a transfer, even if it's by way of a gift or irrevocable trust. Second, most important, there is a huge change in period of holding. What is the meaning of long-term capital asset, which is not a short-term capital asset? What is the meaning of short-term capital asset? A capital asset which is held by the person for less than or equal to 12 months, or for some asset 24 months, or for some asset it was 36 months. So if you hold the asset particularly for this much month, it will be called as short-term. And if you transfer the capital asset after such month, it will not be regarded as a transfer. It will be called as long-term capital asset. What was covered under 12 month? Listed bond, listed debenture, listed securities, means listed shares, etc. Units of Unit Trust of India, units of equity oriented mutual fund, zero coupon bond. These four assets were covered under 12 month. Unlisted shares, land ya to building, was covered under 24 month. And any other asset like jewelry, unlisted bonds, debentures, hybrid mutual fund, debt oriented mutual fund which is acquired prior to 1st April 2023, units of business trust, all these things were covered under 36 month. So once again, what was covered under 12 month? Listed bond, listed debenture, listed shares other than units, because that is covered under 36 month. Units of equity oriented fund, units of UTI, zero coupon bond, all this 12 month. 24 month unlisted shares, land ya to building, and any other asset is covered by 36 months. Jewelry, unlisted bond, unlisted debenture, debt oriented fund acquired prior to 1st April 2023, hybrid mutual fund ya to business trust ke units, 36 month. And there are certain assets which is always called as short term irrespective of period of holding. That was a section called 50AA. Two assets were compulsory called as short term. First, any debt oriented mutual fund which is purchased, acquired on or after 1st April 2023. And whenever you transfer, it will be always called as short term. Second was market linked debenture, a debenture which value derived from market, and that is also always called as short term. But this entire table is applicable only if the transfer of a capital asset is done up to 22nd July 2024. You have to remember, see, in capital gain, whatever is the amendment, except few amendments, all the amendments are applicable in a transitional manner. Means you have to remember both the things, old provision also, new provision also. Old provisions were mainly applicable up to 22nd July 2024 if transfer is done up to that date. If transfer is done on or after 23rd July 2024, then those amendments will come into the picture. So yes, this entire thing which we discussed, 12 month, 24 month, 36 month, section 50AA, certain asset always called as short term. These points are applicable if transfer done up to 22nd July. Now, what if the transfer of a capital asset is done on or after 23rd July 2024? Now they have bifurcated the period of holding just into two parts, either 12 month or 30 or 24 month. There is nothing called as 36 month. They have withdrawn 36 month ka period. Now, what is applicable in 12 month? So if this asset is held only for 12 months, on or after 23rd July, if you transfer, it will be called as short term. First, listed bond, listed debenture, securities, including all listed units. So now any listed thing is covered by 12 months. Even though it is a business trust unit, hybrid mutual fund, debt-oriented mutual fund acquired prior to 1st April 2023. Can I say all this were covered earlier in 36 months, which is now transferred directly to 12 months. So if it is hold up to 12 months, it is short term. If it is transferred after 23rd July 24, and if it is transferred after 12 months, then it will be called as long term. So if you transfer this particular bracket wale asset prior to 23rd July, we have to see 36 months. You transfer after 23rd July, now we have to see 12 months. Achha, the other asset remains same. Unit of UTI, equity oriented mutual fund, zero coupon bond, it is same. And balance all the other asset is covered under 24 months. Land, building, unlisted shares, that was earlier also. Jewelry is also transferred now to 24 months, which were earlier there in 36 months. But now there is one change in section 50AA also. Up to now, only two assets were there in 50AA, which is always regarded as short term. First was debt-oriented mutual fund acquired on or after 1st April 23. Second is market-linked debenture. It is still there. Third asset is added to this list. If any unlisted bond or debenture is transferred on or after 23rd July 24, it is always regarded as short term. Earlier unlisted bond or debenture, if you transfer up to 22nd July 24, it was covered under 36 months. So if it is sold after 36 months, it would have regarded as long term. But now the transfer is done on or after 23rd July 24, unlisted bond or debenture will always be regarded as short term. Indexation, etc. never allowed. Tax rate will be applicable as if it is short term. So slab rate basically. Short term capital gain is generally taxable at your Finance Act, that is slab rate. So now onwards, whenever you transfer unlisted bond or debenture, slab rate will be applicable. So what are the changes? Up to 22nd July 24, no changes at all. Whatever you have studied will continue. From 23rd July 24, what is covered under 12 months? So if you transfer up to 12 months short term, otherwise long term, what is covered under 12 months? Listed securities, that is shares, bond, debenture, hybrid mutual fund, debt oriented fund acquired prior to 1st April 2023, business trust unit, unit of equity oriented mutual fund, UTI, zero coupon bond. What is covered under 24 month remaining all the asset? Jewelry, land, building, unlisted shares. And what is covered under 50AA, that is always regarded as short term? Debt oriented mutual fund acquired on or after 1st April 2023. Market linked debenture, and basically unlisted bond or debenture transferred on or after 23rd July 2024. Please understand, there is a difference. This debt oriented mutual fund is always regarded as short term if acquired on or after 1st April 23. And unlisted bond or debenture is always regarded as short term if it is transferred on or after 23rd July 24. One is depending on acquisition date, one is regarding transfer date. So please take care of this particular thing. Now, a very huge amendment, because of which on 23rd July our stock market crashed like anything. And this budget was counted as a very weak budget in the eyes of taxpayer, in the eyes of opposition parties. Amendment has been done in section 48. What is the amendment? Up to 22nd July 2024, if you transfer any capital asset which is a long-term capital asset, while calculating cost of acquisition, you would have got indexation benefit. So while calculating long-term capital gain, what we were deducting? Index cost of acquisition, index cost of improvement. Obviously, if you transfer any bond or debenture, indexation was not allowed. Listed shares covered under 112A, indexation was not allowed. Slump sale, indexation was not allowed. That is that. But for all the balance asset, can I say if it is a long-term capital asset, the main benefit was in spite of cost, we were getting index cost, either acquisition or improvement. Now they have removed the concept of indexation. So if on or after 23rd July 2024, you transfer any capital asset, you will never get indexation benefit. While calculating total income, you will never get indexation benefit. Many people protested against this. They said that indexation should be there. To please the taxpayer, they have came up with one more amendment, but that amendment is done in 112. You must have heard that indexation is restored. Now they are giving the option with indexation or without indexation wala option. That option also we will discuss in this lecture, but that option is given under section 112. What I mean? For land and building, that option is given that you can calculate your capital gain with indexation also, without indexation also. But that option is not applicable while calculating the total income. I have seen so many faculties who are saying this, that while calculating total income also you can claim the indexation. Never. While calculating total income, it will be always without indexation. But while calculating tax, for few people, for few asset, we have to calculate again the capital gain with indexation or without indexation, and some different tax rates are given. Final tax payable will be whichever is lower. This thing I will cover in detail after 5 minutes. As of now, what you remember is, while calculating any capital gain, and if the transfer is on or after 23rd July 2024, you are not supposed to take indexation benefit while calculating total income, while calculating capital gain. Either on cost of acquisition or on cost of improvement, both the indexation has been removed. But please remember, now in any capital gain question which comes into your examination, what is your first duty? You have to see the transfer date. If the transfer date is up to 22nd July 24, all the previous provisions are applicable. Indexation also applicable. But if the transfer is on or after 23rd July 2024, then indexation benefit is removed. So now no indexation benefit if long-term asset is transferred on or after 23rd July 24. For cost of improvement also, no indexation benefit if transferred on or after 23rd July 24. So now before I move forward, I forgot one thing to tell you. We just discussed that period of holding now has been just two-way, either 12 month or 24 month. But there is one small problem with the act, either drafting error or intentional error, we don't know. In slump sale, that is section 50B, if business undertaking is held up to 36 months, it is short term, otherwise it is long term. Even after 23rd July also, for slump sale, the period of holding is still 36 months. There is no change over there. So if you are calculating any question which is regarding to slump sale, still the period of holding is to be seen 36 months. There is no change in that particular point. Now, a very big amendment which shook so many IT companies particularly, buyback. Okay. See, the budget which came on 23rd July, there are few changes which they have made applicable from 1st April 24. Some changes they have made applicable from 23rd July 24. For example, the book profit wala change in PGBP, all the changes which we have seen up to now is all applicable from 1st April 24. That gift for individual HUF, it is not regarded as transfer. For others, it will be regarded as a transfer. This is also applicable from 1st April 24. But the period of holding ka change, indexation ka change is from 23rd July. However, the buyback wala change which we are going to see now is applicable from 1st October 24. You have to remember each and every cutoff date. Now understand what was happening up to now. 30th September 24. If any company has done a buyback up to 30th September 24, either that buyback has been done by a domestic company or that buyback has been done by a foreign company. If the buyback is done by a foreign company, company is not supposed to pay anything to the shareholder. Entire capital gain will be taxable as per section 46A because the capital asset is being transferred. Whatever amount is received is called as full value of consideration minus cost of acquisition or index cost of acquisition. 23rd July के पहले है तो. So balance will be called as capital gain or capital loss. Like normal share sale, buyback was also same for them. But if it is a domestic company and if the buyback is done up to 30th September 2024, can we say all the taxability was laid upon company? That company is supposed to pay additional income tax at the rate of 23.296%. which is 20% tax plus compulsory 12% surcharge plus 4% cess, which leads to 23.296%. And can I say the entire taxability is paid by company, hence to the shareholder, the buyback was exempted under section 10 clause 34A. Neither taxable under IFOS nor taxable under capital gain, because company has paid the tax. Benefits were taken by so many promoters who has huge shares. Instead of selling to the market, they will sell directly to the company. And when they are selling it to the company, they will get capital gain exemption because the entire capital gain tax liability is paid by the company. So the promoters were being happy because they are not supposed to pay the tax in spite of the huge profit. Rather, the company will pay the tax. Perfect. Now, if the buyback is done from 1st October 2024, by the way, this 23.296% rate is given under which section? It is given under section 115 QA. Now, from 1st October 2024, what they have done? They have removed section 115 QA. They have removed section 10 clause 34A, meaning thereby now company is not supposed to pay any kind of additional income tax on buyback. Entire taxability is now shifted to the shareholder, like shareholder of a foreign company. So earlier also, if buyback was done by a foreign company, company was not supposed to pay the tax. Shareholder was supposed to pay the tax. It was not the case with domestic company. Now from 1st October 24, if buyback is done by domestic company, same company is not supposed to pay any kind of tax. The entire taxability has been shifted to whom? Shareholder. So 115 QA is removed. Removed from which date? 1st October 24. And just because company is not supposed to pay the tax, can I say the exemption is not available to the shareholder? So 1034A is also removed. The question arises, now how this buyback will be taxable to the shareholder? Now that is interesting. What they have said, if any domestic company is doing any kind of buyback, then whatever amount is given to the shareholder, that amount will be taxable to shareholder as deemed dividend. Deemed dividend. Under section 222F, one more clause added to this particular section, 222F. Up to now, deemed dividend was 222A till 222E. Now, one more subclause is added, 222F, with effect from 1st October 24. So, whatever amount company has given as a buyback to the shareholder, it will be taxable to shareholder in IFOS as the deemed dividend of 222F. But can I say the shares of the shareholder are also transferred? The shares are also transferred. And if the shares are transferred, can I say capital gain tax liability arises? Definitely yes, because the exemption is also not there. So capital gain will also come into the picture. Right? Two heads for one income. Yes. If company is doing buyback, to the shareholder, first, the entire amount received will be taxable under IFOS in the name of deemed dividend, section number 222F, without deducting any kind of cost. So gross income will be taxable over here. Whatever is received from the company without any further deduction, taxable under IFOS. But can I say the capital asset is also transferred? Shares are also transferred. So capital gain will also arise under 46A. But the full value of consideration will become zero. Now, why it will become zero? Can I say entire sale value is already taxed under IFOS? So if you write the same value in full value of consideration, it will lead to double taxation, which we don't want. So what is assumed? Full value of consideration is zero. Then why to calculate capital gain? To reduce the cost of acquisition. See, this can never be index cost because anyways, we are referring to the transactions on or after 1st October 24. And from 23rd July, indexation is removed. So what you can just deduct over here, cost of acquisition. Let's say I have purchased the shares for rupees 1 lakh. So my cost will be deducted as rupees 1 lakh. Full value of consideration is zero. This will always lead to capital loss, either short term or long term. It will be always a capital loss. Let's say here capital loss is 1 lakh. So what they could have simply done, they could have reduced the cost from this deemed dividend. And they would have said that capital gain is not applicable. No. They want to defer your deduction. See how brilliantly they brought this provision into the picture. Your full value of consideration is taxable under IFOS. Capital gain is also taxable, wherein the full value of consideration will be referred as zero. Cost can be deducted, so there will be a capital loss. But please remember, as per set off chapter, this capital loss cannot be set off against IFOS income. Capital loss can just be set off against capital gain income. So can I say if there is no other capital gain, this capital loss will be carried forwarded. And today you are supposed to pay tax on this gross income without any deduction. So they have deferred your deduction in such a manner. So yes, this entire provision is applicable if the buyback is done on or after 1st October 2024. Prior to that, whatever you have learnt was applicable. From 1st October 24, so you have to remember both the things, by the way. So I have written, earlier for buyback done by domestic company is supposed to pay additional income tax at the rate of 23.296%, and it was exempted for the shareholder under 10 clause 34A. On or after 1st October 2024, for buyback done by domestic company, following will apply. For buyback of shares as per section 68 of Companies Act, removal of section 10 clause 34A. So buyback is now not exempted from 1st October. Removal of 115 QA. Now company is not supposed to pay any kind of additional income tax from 1st October. 222F added from 1st October, when the gross amount which is received from the company is taxable as a deemed dividend under IFOS. You can't deduct any kind of cost. And just because it is a deemed dividend, the company which is paying this amount will deduct TDS under 194, because while paying the dividend, if more than 5,000, company is supposed to deduct TDS at the rate of 10%. So company will deduct your TDS under 194 because this is a deemed dividend for the shareholder. Amendment is done in section 57, which is a deduction of IFOS, that against this deemed dividend of 222F, you cannot take any deduction, even the interest on the loan, which is generally allowed up to 20% of dividend. That interest expense is also not allowed against this buyback. This buyback is fully taxable. What further amendment they have done? 46A, removal what is wrong. Amendment in 46A, from 1st October they have said that whenever a domestic company do the buyback, the capital gain arises to the shareholder. But please assume that full value of consideration is zero because it is already taxed under IFOS. So they have assumed FVC zero. Cost will be taken as a deduction, so there will be a capital loss, and that capital loss cannot be set off against IFOS. Now I have written one example over here. Mr. A has purchased the shares of ABC Limited for rupees 1 lakh in the year 2017-18. Now on 1st November 24, dates are very important for your attempt. Company is doing buyback for rupees 2,20,000. During the year, Mr. A has another long-term capital gain of rupees 5 lakh. Then what will be the total tax treatment? Acha, tell me, what if this buyback is done, let's say on 30th September 24? So can I say company would have paid additional income tax, and for the shareholder this buyback was totally exempted, neither IFOS nor capital gain. But this buyback is done on which date? 1st November 24. That is, can I say on or after 1st October 2024? So yes, amendment will come. And as per the amendment now, there is nothing called taxability of a company. Company is not required to pay any kind of tax. What company is just supposed to do? While paying this amount of rupees 2,20,000 to the shareholder, company will deduct TDS under 194 because company is paying a deemed dividend to the shareholder. So company will deduct TDS under 194 at the rate of 10%. Now for the shareholder, what will be the total taxability and how it will work? First, can I say whatever amount is received from the company as the buyback amount, that is taxable under IFOS as a deemed dividend under which section 222F. So this 2,20,000 will be taxable under IFOS, and you cannot deduct any kind of deduction because section 57 has restricted that. But can I say shares are also transferred? So simultaneously, which head will come into the picture? Long-term capital gain. And as you can see over here, unlisted shares transferred on or after, basically after 24 months, and hence this capital gain will be called as long-term capital gain. But the transfer is done on or after 23rd July 24, so indexation benefit will not be available. Now, can I say just because the entire 2,20,000 is taxed already in IFOS, the full value of consideration is called as zero, but you can deduct cost of acquisition. And how much cost of acquisition you can deduct? 1 lakh. So that will lead to rupees 1 lakh ka long-term capital loss. But you already have the long-term capital gain of any other asset called 5 lakh. And you know long-term capital loss can be set off against long-term capital gain. So this loss will be set off against this gain and ultimate LTCG will be 4 lakh. And your IFOS income will be 2,20,000. Total income will be 6,20,000. Assuming no other income. Tell me one more thing. What if over here I would have not given this long-term capital gain of any another asset of 5 lakh? Then can I say this 1 lakh rupees of loss I would have directly carried forwarded. It cannot be set off against IFOS. Now what will be the total income in that case? 2,20,000. And which loss I will carry forward? 1 lakh rupees of long-term capital loss. Are you understanding this entire concept of buyback? Please remember, old provision also you need to remember, but that is applicable up to 30th September 24. New provision definitely you are supposed to remember, but that is applicable from 1st October 24. As we already discussed, there is a change in section 50AA. From 23rd July 24, if any unlisted shares, unlisted bond, unlisted debenture are transferred, mature, redeemed, and the transfer date is 23rd July 24 or afterwards, it will always be called as short term. And just because it is always called as short term, the gain will also be called as short term capital gain. The another 2 points remains as it is. Now, pay 100% focus because we are going to discuss now a drastic change which is brought into the picture so far as tax rates are concerned. See, there are 3 or 4 drastic change in this chapter. First, they have restricted the gift wala provision, which is not regarded as a transfer, only to individual HUF. Second, they have removed indexation benefit on or after 23rd July 24. Third, they have changed your period of holding. Fourth, they have changed the buyback provision. Fifth, they have changed the entire tax rate structure so far as capital gain is concerned. As we know, in old regime, there is no change in the slab rate. There is a change in 115 BSE ka tax rate, which we already saw. There is a change in the tax rate belonging to capital gain. But the change is again transitional. Now, if transfer is done up to 23rd July, the same thing is applicable, whatever we have learnt in your attempt, except one change, which is from 1st April. Balance all provision is applicable as per last attempt. If the transfer is done on or after 23rd July, the provision has been changed. Now, let us remember first of all old provision. What is the tax rate if the transfer is done up to 23rd July 2024, or I can say up to 22nd July 2024? You have to see which kind of asset you have transferred. Either it can be listed shares or equity oriented mutual fund, or can I say units of business trust. Either you would have sold through stock market or you have sold outside stock market. If you have sold through stock market, that means security transaction tax is paid. Either it can be short-term capital gain or it can be long-term capital gain. Now, if it is a short-term capital gain, the tax rate applicable was under 111A, which is at the rate of 15%. And if it is a long-term capital gain, the tax rate was applicable 112A. If capital gain is up to 1,25,000, there is no tax. More than 1,25,000, 10%. Please remember, earlier the limit was 1 lakh. Now they have changed the limit. They have increased the limit to 1,25,000. But this 1,25,000 limit is applicable from 1st April. And hence, if the transfer is run up to 22nd July 24, still, this will be more than 1,25,000 at the rate of 10%. So earlier it was 1 lakh, now it is 1,25,000. The other rates remain same. If you transfer outside stock market, STT is not paid. If it is short-term capital gain, it will be taxable at slab rate, your finance act rate, like a normal capital gain. And if it is a long-term capital gain, section was applicable 112, which is 10% without indexation or 20% with indexation, whichever is lower. And the same point is applicable for listed securities also. So for a listed bond, listed debenture, same tax rate is applicable. But if you transfer any other asset, either it can be short term or it can be long term. If it is long term, section was 112, 20%. Obviously, at that time, indexation benefit was applicable. And if it is a short term, it is always, can I say, slab rate. So this is the provision which is applicable up to 22nd July 2024. When 111A was having 15%, 112A was having more than 1,25,000 10%, and normal section 112 was having 20%. Now what change they have done? If the transfer is done on or after 23rd July 2024, so transfer date is very important. It will change computation method also, it will change tax rate also. If the transfer is done on or after 23rd July 24, either your asset can be listed security or unit of equity oriented fund or unit of business trust. If you transfer either through stock exchange or outside stock exchange, if you transfer through stock exchange, security transaction tax applicable. If it is a long-term capital gain, section will be 112A, more than 1,25,000, 12.5%. Earlier it was 10%, now it is 12.5%. So what they have simply done, they have increased the tax rate related to stock market. Because so many people were earning through stock market. So what they have simply done, they have increased the tax rate. Now people have stopped earning from stock market because stock market has been crashed. But okay, earlier it was 10%, now it is 12.5%. Limit will remain same, 1,25,000. And if it is short-term capital gain through stock market, earlier 111A, now also 111A, earlier 15%. Now again over here tax rate increased to 20%, 5% increase. So tell me one thing, I have a short-term capital gain of listed share which is transferred from stock market. Up to 22nd July 2024, it is 5 lakh. On or after 23rd July 2024, it is 6 lakh. How to compute capital gain tax? Assuming my other income is up to 2,50,000, so shifting benefit is already taken care of. What will be the pure tax rate applicable to this two income? Can I say on this 5 lakh, I will apply 15% because transfer is done up to 22nd July. And on this particular 6 lakh, I will apply 20% because the transfer is done on or after 23rd July. So I have to bifurcate like this. Please tell me, if the long-term capital gain of listed share up to 22nd July 2024, my capital gain is 1,20,000. On or after 23rd July 2024, my capital gain is, let's say, 5 lakh. How to compute tax of this? Now, can I say up to 22nd July 2024, the tax is 10% if the capital gain is more than 1,25,000, and on or after 12.5%. But remember, this limit of 1,25,000 is for the entire year common. So you don't get, separate 1,25,000 ka limit. That limit is common for this too. And that limit is to be used as per FIFO method. First, you have to utilize the limit for the capital gain up to 22nd July. Balance limit will be utilized for the capital gain arising on or after 23rd July. So what will happen over here? 22nd July 24, capital gain is 1,20,000. It is below 1,25,000, no tax. Up to this 5,000 limit is still pending. 23rd July 24, I have a capital gain 5 lakh. Can I say from 5 lakh, first I will deduct that 5,000 ka limit. How this 5,000? 125 limit is there. 120 I utilize. 5,000 is still there. I will utilize against 5 lakh. On balance 4,95,000, I will apply 12.5% because now the tax rate is 12.5% instead of 10%. And that will be my tax. Tell me the answer of this. If my long-term capital gain on listed share up to 22nd July 2024, 3 lakh, and 23rd July 24, it is 1 lakh. How to compute capital gain? So what I will do first, from this 3 lakh, I will deduct 1,25,000. So what will be the balancing amount over here? Can I say 1,75,000? And of that, I will apply 10% tax, which will be 17,500. And on the capital gain arising on or after 23rd July 24, that is rupees 1 lakh, I cannot deduct 1,25,000 ka limit because it is fully utilized. Now against this directly I have to apply 12.5%, which will be 12,500. So my total tax over here will comes to 30,000. Are you getting this, people? So this is how you need to apply. See, if they have given the capital gain only up to 22nd July, there is no issue. You will use 125, you will apply 10%. If the capital gain belongs to the period on or after 23rd July only, you will use 125, you will apply 12.5%. But if both the capital gain is given in your question, prior to 22nd July also, after 23rd July also, first 1,25,000 will be utilized against the first capital gain, which arises prior to 22nd July. Balance will be utilized against further capital gain and the rate will be proportioned accordingly. So that is how the amendment works. And if it is 111A, as I just discussed, instead of 15%, now the tax rate will be 20%. Achha, what if it is transferred outside stock market? STT not applicable. Then if it is long-term capital gain, section will come 112, only one rate, 12.5%, compulsory without indexation, because now indexation is not applicable. And the same thing is applicable for listed bond, listed debenture also. So now if any listed bond or debenture is transferred on or after 12 months, which is long term, for that also compulsory, which rate will be applicable? 12.5% under section 112. And if it is a short term capital gain, Finance Act, that is slab rate. So for any other asset, if you transfer any other asset, if it is a long term capital gain, section will come as 112. Earlier it was 20%. Now it is just 12.5%. That is the justification that our Finance Minister Nirmala Sitharaman Madam has given, that why we have removed indexation benefit, because we have reduced the tax rate substantially. Earlier it was 20%, so indexation benefit was given so that your capital gain reduces and on that you apply 20%. Now we are reducing the tax from 20% till 12.5%. So obviously, we will remove indexation benefit. Your capital gain will increase, but can I say the tax rate has been reduced? But this particular argument does not qualify much because there is still a huge tax gap and the tax payable of people has substantially increased. And if it is a short-term capital gain, it will be what? Finance Act, budget. Achha, can I say this 12.5% will be always without indexation now? Because now indexation benefit has been removed. So tell me, if we talk about whatever is the capital gains up to 22nd July 24, ya to we are discussing on or after 23rd July 2024. If it is your listed shares, etc., through stock market, short-term capital gain under section 111A, can I say earlier it was 15%, now it is 20%. If we discuss about section 112A, that is long-term capital gain of listed share through stock market, can I say more than 1,25,000, 10%? Now it is more than 1,25,000, 12.5%, but the limit of 1,25,000 is common. And if we discuss about any other capital gain, earlier it was 20%, generally with indexation. Now it is 12.5% without indexation. Up to now, things are clear. Now tell me, up to now, if you were getting shifting benefit, what is shifting benefit? If my slab rate wali income is below basic exemption limit, whatever is the balance amount, I would have shifted to my special income. In what hierarchy you would have deducted that basic exemption limit? If the transfer is done up to 22nd July, first I will utilize against 112 because it is taxable at 20%. Then I will utilize against 111A because it was taxable at 15%. Then if still that basic exemption limit is remaining with me, I will utilize it against 112A because it is only applicable at the rate of 10%. But now if the transfer is done on or after 23rd July 2024, the shifting benefit ki sequence will change. First, I will use basic exemption limit obviously against my slab rate wali income. But if my slab rate income is lower than basic exemption limit, let's say my slab rate ki total income is only 2 lakh. Basic exemption limit is 2,50,000, old regime. 50,000 limit is still applicable with me, still remaining with me. First, I will utilize against 111A because now the tax rate is higher, 20%. Then I will utilize it against 112A because it is 112 because now it is only 12.5. And whatever is the balance now will be awarded to 112A. It is also 12.5% with a limit of 1,25,000, and that's why it is kept in the last. So now the shifting benefit will also change. Earlier it was 112, 111A, 112A. Now it will be 111A, 112, 112A. Achha, the other things remain same. Earlier also, chapter 6A ka deduction was not available against any special rate income, which is now also not available. My deduction is always restricted to slab rate income. Earlier also, I would have claimed the rebate of section 87A against 111A, against section 112, not against 112A. Now also, I cannot claim rebate against 112A. Earlier also, 25% and 37% surcharge was not applicable against 112, 111A, 112A. Now also, it is not applicable against 111A, 112A, 112A. Maximum surcharge will be 15%. On dividend also, maximum surcharge will be 15%. Okay. Let us solve first of all 3 examples based on this, and then I'll come to the most crucial part of this tax rate. First of all, some example which belongs to old system, old provisions, because that is also applicable to you. Some example as per the new provisions. First example. In my notes, generally I give this example, which many of you must be having. Mr. A, who is a resident 59 years. Assume that all the transfer is done prior to 23rd July 24. Assume that the person has shifted out of default regime. That means following old regime. Which income I have given? Salary which is computed 90,000. So 50,000 standard deduction is taken. Interest 50,000. 111A का STCG rupees 2 lakh. Listed share sold through stock market. House property computed 30% standard deduction is taken 40,000. Short-term capital gain of silver. Can I say other short-term capital gain is always taxable at slab rate 50,000. And long-term capital gain 40,000. If nothing is said, this long-term capital gain is not of listed share. It is of any other asset that is covered by section 112. If I do the total of all, my total income comes to 4,70,000, which I need to bifurcate into 2 parts. One is normal rate, slab rate. One is special rate. Can we say there are 2 special rate income involved in this question? One is short-term capital gain 111A. One is long-term capital gain 112. And all the transfer belongs to prior to 23rd July. So under section 111A 15%, under section 112 20%. First I will note down 112 because it has higher tax rate, and that is 40,000. And 111A ki income is rupees 2 lakh. So my balance income, can I say 2,30,000 belongs to slab rate. And on that 2,30,000 tax will be 0. The simple reason is up to 2,50,000 there is no tax in the old system. So how much basic exemption limit is still remaining with me? Can I say 20,000? And this person is a resident person. See, please understand, shifting benefit is only applicable to resident. It is not applicable to non-resident. If in the case of non-resident, this limit is remaining, it will be vested. But this is a resident person. 20,000 ka shifting benefit will be available. First, it will be available against 112. So I deducted 20,000. On balance 20,000, I will apply 20%, which is 4,000. There is no shifting benefit available now. So for entire 2 lakh, I will apply 15%. That will be 30,000. Total basic tax comes to 34,000. And my total income is less than or equal to 5 lakh. So rebate is applicable because the person is a resident individual. But maximum rebate is 12,500. Balance is 21,500 plus 4% cess 22,360. Second example. Mr. B, who is resident, 61 years. Assume again all the transfer is done prior to 23rd July 2024. House property income, can I say nothing is written about computed, uncomputed, but the wordings are written house property income. So it is always to be assumed computed. If I would have written the word rental income, then compulsory you will deduct 30% standard deduction, but the wordings are house property. I can assume it computed. Short-term capital gain on gold. Can I say any other asset ka short-term capital gain is always taxable at slab rate? Long-term capital gain under 112A 1,55,000. Long-term capital gain on land 50,000. Short-term capital gain under 111A 1,20,000. Now this is the written 111A. Long-term capital gain on land, can I say it will be covered by section 112? So there are 3 special rate income available in this particular question. First, 4,95,000 will be divided into two parts. This chart format you can use in your examination in a working note. Slab rate income, special rate income. I have three special rate income: 112, 111A, 112A. That is the hierarchy of shifting benefit. First, I will write 112, that is 50,000. Then I will write 1,20,000, and third one is 1,55,000. And all this capital gain are prior to 23rd July 24. My general income is 1,70,000 and tax will become 0. But can I say this person is the resident senior citizen? Basic exemption limit comes to 3 lakh. I have used only 1,70,000. How much is still remaining with me? 1,30,000. First, I will use entire against this. So can I say 50,000 minus 50,000, it will become 0. 1,30,000 was the limit available. I utilized 50,000. How much is still available with me? Can I say 80,000? This I will utilize against 111A. So 1,20,000 minus 80,000, it comes to 40,000. On that, I will apply 15%. It will become 6,000. And whatever is the income of 112A, can I say now shifting benefit is not available because entire shifting benefit is utilized. But 112A itself has a limit called 1,25,000. So I will use 1,25,000. Balance will be 30,000. And on that, I have to apply 10% because prior to 23rd July. And that will come to 3,000. Now my total basic tax comes to 9,000. And you can see the person is a resident individual. Total income is up to rupees 5 lakh. Rebate is applicable, but please understand, rebate is not applicable against the tax of 112A. So can I say against this 3,000, I cannot claim rebate. My rebate is restricted to this 6,000. So from the basic tax of 9,000, I will just take rebate of 6,000. And on balance 3,000, I will add 4% cess. Total will be 3,120. This is how the tax to be computed. Now this one. Mr. Rahul has the following income. He is following default tax regime. He is 80 years. He is resident. Assume all the below transfer takes place on or after 23rd July 24. Salary which is computed, rupees 2 lakh. Can I say the standard deduction is already taken, and that too 75,000? Because now if a person follow default tax regime of 115 BAC, the standard deduction is 75,000 instead of 50,000. So here I have already deducted that 75,000, which comes to rupees 2 lakh. Long-term capital gain of unlisted share 50,000. Please understand, unlisted bond या unlisted debenture is always assumed short-term. Unlisted shares can be long-term, can be short-term, depending on 24 month. Long-term capital gain of listed share, which is taxable at 112A. Can I say unlisted share ka LTCG 112? This is 1,30,000, and STCG of listed share, that is 111A, that is taxable at 5,40,000. So what are the tax rate that will apply? This 112, this all are after 23rd July. So basically this will be 12.5%. This will also be 12.5% over and above 125. And this will be 20%. Total income comes to 9,20,000. Again, I have to divide this into two parts. General income, special income. Special income will contain again three parts, but now the shifting benefit sequence has been changed. So first I have written 111A, then I have written 112, then I have written 112A. So 111A ki income comes as 5,40,000. This comes as 50,000, and this will be 1,30,000. The general income comes as rupees 2 lakh. Now many students have got confused by looking at the example when I shared these notes with them. So this person is of 80 years. Basic exemption limit is 5 lakh. No beta, this person is following default tax regime. The basic exemption limit will always be 3 lakh. So here also the limit of 3 lakh will apply. Out of 3 lakh, 2 lakh limit will be utilized. The person is a resident person. Shifting benefit will be available. 1 lakh rupees is the shifting benefit. First, it will be utilized against this 111A. Now 4,40,000. Against that, I will apply 20%, 88,000. Now no shifting benefit is remaining with me. Against this 112,50,000, I will apply directly 12.5%, which will be 6,250. Point to be noted, even though it is long-term capital gain, can I say it will be always without indexation? Because the transfer is done on or after 23rd July. So I have to assume that this LTCG is computed without indexation. Acha, against this 112A, Can I say up to 125 there is no tax? On balance 5,000, 12.5%, which will be 625. There is no question of rebate because total income is anyways more than 7 lakh. And hence, whatever is the total basic tax, I will apply 4% cess 98670. This is the tax payable. Anybody any doubt over here? No. Very important point. And the last point, which is a capital gain ka amendment, but a crucial amendment. Trying to say, please grasp in your mind, up to 22nd July 24, indexation benefit was applicable. The tax rate was 20%. On or after 23rd July 24, indexation benefit has been removed. So tax rate comes to 12.5%. But still, many taxpayers were saying that this budget is not in the favor of taxpayer. It increased our tax like anything. To please the voters, to please the taxpayer, what Nirmala Madam has done an amendment. If you are a resident individual HUF, you are transferring your land or building on or after 23rd July 2024, but this land or building was acquired prior to 23rd July 24, then what will be your tax rate under section 112? It will be 12.5% without indexation, or recompute your capital gain with indexation and take 20% on that. Finally, you have to pay the tax whichever is lower. 12.5 without indexation or 20% with indexation, whichever is lower. So that if your position before this amendment was lighter, you can still follow that tax. And if your position after this amendment is better, you can follow this new tax. You follow whichever is more beneficial to you. Either you calculate your capital gain with indexation, apply 20%, means follow as if you are prior to 23rd July. Yeah, so you follow the new system that is 12.5 without indexation and you finally pay the tax whichever is lower. So, okay, but what is so complex in this? As I said, this amendment is done in section 112, meaning thereby this comparison is to be done just while calculating the income. This option is available just while calculating the tax. While calculating the income, while calculating your total income, while calculating your capital gain, if I ask you what is my capital gain, if I ask you what is my total income, you will never use this option. You will never take indexation because indexation benefit is removed. Your income will be always without indexation, even though it is land ya building. Indexation wala option is available just while calculating tax payable. And this option is only applicable with resident individual HUF, only for land ya building. This option is not with any other firm, company, etc. This option is not with non-resident. They compulsory have to pay 12.5% without indexation. This option is not with a resident person for any other asset like jewelry, unlisted share, always 12.5% without indexation. It is a very limited option. Resident individual HUF transferring land ya building acquired prior to 23rd July, transferred on or after 23rd July, tax will be 12.5 without indexation or 20% with indexation, whichever is lower. What I have written in a note, this rule is not applicable to non-resident, it is not applicable to other resident, it is not applicable to resident individual HUF for other asset, it is not applicable to resident individual HUF for land ya building acquired after 23rd July. This rule is only for tax calculation. Income will always be computed without indexation. Okay, this line you can safely ignore for inter C. It was mainly for final C. Now I have written one question on this to explain how this works. Okay, prior to that, let me give you a simple question. Let's say I'm a resident individual, 50 years, old regime, PGBP income 7 lakh. Long-term capital gain on transfer of land, let's say 30 lakhs. Now, if I tell you that this land is transferred on 23rd July 24, that means can I say I have assumed that this long-term capital gain is calculated compulsory without indexation. Yes or no? Yes. This is calculated without indexation. So now if I ask you what is my total income, whether you will have the option of with indexation, without indexation, no. My total income is called as 37 lakh. That is fixed. No change in this. Now I am telling you to compute tax payable also. While calculating tax payable, can I say 37 lakh rupees will be bifurcated into two parts. One is general income, one is 112. General income is 7 lakh, 112 is written as 30 lakh. 7 lakh, can I say I will apply my normal old regime ka tax up to 5 lakh 12,500. Above 5 lakh 20%, that will be 40,000. Total will be 52,500. Now, on this 30 lakh rupees, which is taxable under section 112, I can directly not apply 12.5% because the person is a resident, individual, transferring land or building on or after 23rd July 24, which must have acquired prior to 23rd July 24. So the tax is applicable 12.5% without indexation or 20% with indexation, whichever is lower. So I have to prepare a working note over here. And in the working note, I will calculate what will be the basic tax. One thing is pretty sure, shifting benefit is not applicable because entire basic exemption limit used over here. Now in the working note, first what I will do, 30 lakh which is without indexation, of that 12.5%. So tell me, what is the tax over here? Can I say it will be 3,75,000? Now I have to recompute the capital gain with indexation. That cost of acquisition if it is indexed, cost of improvement if it is indexed, then I will deduct the exemption of 54, 54 EC, etc. Then what is remaining capital gain? Let's say with indexation, capital gain comes to only 10 lakh rupees. So without indexation, it was 30 lakh. If I apply indexation, it is only 10 lakh. Now on this 10 lakh rupees, I will apply how much? 20%. So it comes to rupees 2 lakh. Finally, whichever is lower, 2 lakh. So on this 30 lakh rupees of income, my basic tax is called as rupees 2 lakh. My income will not change. It will not be called as 10 lakh. Income will be called as 30 lakh without indexation. Tax will be called as 2 lakh. So finally, what is the total basic tax over here? 2,52,500. On that, I will apply 4% cess. So my final tax payable will come to 2,62,600. Are you understanding this? Now I have drafted one question over here. Mr. A has the following income. Let's assume he's 50 years, old regime. IFOS income rupees 2 lakh. Long-term capital gain of building acquired in 2017-18, that is prior to 23rd July 24, rupees 70 lakh. And let's assume that transfer is done on 23rd July 24. So transfer done on or after 23rd July 24 of a land or building which is acquired prior to 23rd July 24. And the person covered by the question is, can I say resident individual? And obviously the transfer is done on or after 23rd July. So capital gain is computed without indexation. But I have written in the bracket, if we calculate with indexation, it will be only 20 lakh rupees. I'm understanding up to now. What I'm supposed to do? Calculate total income, calculate tax payable. How we'll do that? First, we'll focus on calculating total income. What is my IFOS income? Can I say it is 2 lakh? Then what I will add over here? Long-term capital gain. Tell me, while adding into the income, which one I will take it? 70 lakh or 20 lakh? Compulsory 70 lakh without indexation. So what will be my total income over here? 72 lakh. Please understand, my total income is 72 lakh. That is more than 50 lakh. But up to 1 crore, whatever will be my tax, compulsory 10% surcharge will apply because total income is more than 50 lakh. Okay. Now I have to compute my tax payable. Total income is 72 lakh. Can I say it will be bifurcated into two parts? One is general income, one is special income, which is under section 112. General income is how much? 2 lakh. Of 2 lakh, what will be the tax? 0. Achha, under section 112, how much is my income? 70 lakh. Of that, how to compute the tax? Working note 1. Now, in working note 1, can I say this person is a resident individual transferring land or building on or after 23rd July, which was acquired prior to 23rd July, so that option is available. If this would have been any other asset, I would have not thought about the option. I would have directly applied 12.5%. But here, that option is available. because the conditions are satisfied. Now, as per that option, what is option number 1? Can I say without indexation 12.5%? So basically 70 lakh into 12.5%. Yes or no? No. My general income is only 2 lakh. And the basic exemption limit comes to 2 lakh 50,000. Can I say 50,000 shifting benefit is there? So what I will calculate is 70 lakh minus 50,000 ka shifting benefit. That means 69 lakh 50,000. And of this, I will apply 12.5%. So 69 lakh 50,000 into 12.5% comes to 8 lakh 68,750. Acha, what is option number 2 with me? Recalculate the capital gain with indexation. Apply 20%. I have already recalculated, which comes to 20 lakh. In the exam, you need to calculate with indexation given. I have given directly over here. 20 lakh is with indexation. I cannot directly apply 20% on 20 lakh. Now, here also shifting benefit will be deducted now because these are the options, alternatives. So remaining will be 19 lakh 50,000 and against that I will apply 20%, which comes to 3 lakh 90,000. So finally, which tax will be applicable? Whichever is lower, that is 3 lakh 90,000. So on 70 lakh, tax comes to 3 lakh 90,000. What is the basic tax total? 3 lakh 90,000 plus 4% says. No, my total income is more than 50 lakh. Compulsory surcharge will apply. That is 10%. So on 3 lakh 90,000, I will add 10% surcharge, which comes to 4 lakh 29,000. And on that, I will add 4% health and education cess, which comes to 4 lakh 46,160. See, I have tried to cover a question over here when in the surcharge concept also comes, shifting benefit also comes, this option also comes. What was the moral of the story, Udo? Even if your tax is because of 20 lakh rupees of income, but while calculating the income, you have added 70 lakh. And that is the plan of government. If income is higher, surcharge is applicable, then let's not give the option in income. Let's keep income as it is. Option is the only given while calculating the tax. So at least government can earn surcharge because of that higher capital gain. Though the tax has been reduced, but can I say because of the higher income, surcharge will be there, which will be compulsory applicable. Because for the surcharge, we'll see the actual total income. I hope this is pretty clear to you. You can note down the answer over here. You can take the screenshot by pausing the video and moving forward. So this were the entire changes in capital gain. Please don't understand whatever you have learned is not useful. It is applicable up to 22nd July. All these things are applicable on or after 23rd July. Only few changes are from 1st April. First, if individual HUF is transferring by gift will irrevocable trust, then only it is not a transfer. Second amendment which is applicable from 1st April, section 112A. Up to now it was 1 lakh, now it will be 1 lakh 25,000. Third, which is applicable from 1st October, that is buyback. And all other amendments of this chapter is applicable from 23rd July. So amendment related to capital gains are done. Now, amendment with regards to IFOS. 3 amendments are there. One we already studied. In dimmed dividend concept, one more dimmed dividend is added, 222F, with regards to 1st October 24. That any company, domestic company, give you any amount as a buyback, it will be taxable under IFOS in the name of dimmed dividend. Corresponding amendment is done under section 57, that by against the dimmed dividend of 222F, you cannot deduct any kind of expense, even interest expense also not allowed. These two things we already saw in capital gain chapter. Now, up to your previous year 23-24, up to January 25 attempt, you have learned a concept called angel tax. Popularly it was known as angel tax. And we have studied share premium in excess of fair market value. So if a company is issuing a share, the company is a closely held company, share is issued at a security premium, share is issued at a price which is more than fair market value, that excess amount will be taxable under IFOS to the company. That angel tax is removed from 1st April. Means from previous year 24-25, any closely held company issue any share which is more than fair market value, then even though it is issued more than fair market value, nothing is taxable to that company because that particular 56 subsection 2 clause 7b is removed. So now that point is not at all applicable. You can ignore that. Achha, interesting amendment is with regards to family pension. Section 57. There is the deduction section. Up to January 25, what you have understood, if salary income 50,000 standard deduction, if it is a family pension taxable under IFOS, standard deduction is 15,000 or one third of the total pension, whichever is lower. So if Mr. A died and the employer of Mr. A gives the pension to the family member of Mr. A, to that family member it is called as family pension, which is taxable under IFOS, and against that there was a standard deduction 15,000 or one third, whichever is lower. It is still there. But can I say if 115 BSE followed, in salary chapter they increased the standard deduction to 25,000, that is now 75,000. So old regime 50,000, 115 BSE 75,000. Similar change has been done in family pension also. If old regime follow, standard deduction will be 15,000 or one third, whichever is lower. But if 115 BSE followed, that is default tax regime, then standard deduction of family pension will be 25,000 or one third of the total pension, whichever is lower. So here also they increase the standard deduction. Please understand, you cannot directly do in your note 15,000. Let's make it 25,000. No. If old regime, it is still 15,000. If 115 BAC, it is replaced with 25,000. In set of carry forward, there is a small change. If you follow 115 BAC, see, entire chapter is same as it is in old regime. But can I say if you follow 115 BAC, the change is you cannot set off house property loss against any other head. You can only set off against house property income. It is still there. But the amendment is if 115 BAC followed, house property loss can be first adjusted against house property income. Balance loss cannot be set off against any other head, nor it can be carry forwarded. So you cannot carry forward that balance loss. You cannot set off against any other head. You can just set off against current year ki house property income. That's it. So if 115 BAC followed, house property loss cannot be set off against other head, and it cannot be carry forwarded also. What are the amendments regarding deduction under chapter 6A? Only one amendment. Section 80 CCD subsection 2. Employer contribution to NPS. Can I say for NPS or Atal Pension Yojana, that is government pension plan. For 80 CCD subsection 1, you will get employee contribution ka deduction, which is up to 1,50,000 ka overall limit. 80 CCD 1B, additional deduction of 50,000, but all these things is for employee contribution. What if I am an employee? My employer also contribute to my NPS. First, it will be added to my income because it is a perquisite. But can I say now it will be taken as a deduction under section 80 CCD subsection 2. And how much deduction is available? 10% of salary. And if you are a government employee, 14% of salary. Now the amendment is, if 115 BAC is followed, you can still claim 80 CCD subsection 2, that you know. But now the deduction will be 14% of salary for all kind of employee. See, if I follow 115 BAC, entire chapter 6A is not applicable except 80 CCD subsection 2, 80 CCH subsection 2, 80 JJAA. But now, if you follow 115 BAC, 80 CCD subsection 2 is available at a higher level. It will be 14% of salary for all kind of employee, either government employee or non-government employee. So what are the final conclusion? In old regime, 80 CCD 2 will be for other employee 10% of salary, for government employee 14% of salary. If you follow 115 BAC, 80 CCD subsection 2 will be for every kind of employee 14% of salary. Please remember, corresponding change is done in PGBP chapter also. For employer also, the deduction is increased to 14% of salary. But that amendment is for old also, 115 BAC also. Here, the amendment is only with regards to 115 BAC. Are you understanding this? Now, certain important changes are also done in TDS and TCS chapter. First of all, amendment with regards to section 192, that is TDS on salary. Employer will calculate total income of employee. He will calculate tax payable of employee. He will deduct any other TDS if already deducted. And balance tax payable will be bifurcated into 12 months, and that much TDS employer will deduct. But up to now, the act was having a small error. It was saying that if any other TDS is deducted, then only that can be deducted by employer. What if any TCS is collected? Let's say employee has purchased a motor vehicle more than rupees 10 lakh. So that car showroom wala person must have collected TCS of my employee. But while calculating TDS under 192, I was not allowed to reduce that TCS. Now it is allowed. So that double TDS is not deducted. So for salary TDS, any other TDS or any other TCS which is collected or deducted of employee will be reduced. TDS was already allowed, TCS word is added. Okay, not that important. Section 193. You know that 193 interest on security. TDS to be deducted at the rate of 10% without any threshold. But if it is a bond of RBI, TDS is deducted at the rate of 10% subject to the threshold of 10,000. That if the interest exceeds 10,000, then only TDS is applicable. Perfect. Now that 10,000 ka limit is extended to 2 to 3 kind of bonds. So TDS at the rate of 10% will be deducted on interest amount if exceeding 10,000 on 8% saving taxable bonds 2003 which is issued by RBI, 7.75% saving taxable bond 2018 which is again issued by RBI, floating rate saving bond 2020 which is again issued by RBI, or any other security of central government as may be notified or state government. So further bonds they will issue as a notification. And for those bonds also, TDS to be deducted only if the interest exceed rupees 10,000. Then amendment in section 194, TDS on dividend, if it is more than 5,000, 10% at the time of payment. And if it is paid in cash, the threshold is not applicable. From 1st October, if company is paying buyback amount, that is a dim dividend under 222F, then also TDS will be applicable. That I told you in capital gain also, IFOS also. Section 194 IA. TDS on purchase of immovable property. If the value is more than or equal to 50 lakh, actual value or stamp duty on registration, whichever is higher, TDS to be deducted at the rate of 1%. Up to now, whenever I taught this section to any student, in my earlier revision video also you can see this, I have always told one thing. Generally, the limit of TDS is per payer, per payee, per annum. And if it is 194J, per payer, per payee, per annum, per category. But the limit of 194 IA, 50 lakh rupees of limit is per property. Many contradictory judgments were also there, which said no, it is not per property. Finally, government has issued a clarification that the threshold of rupees 50 lakh is not per payer, not per payee, not per annum. 50 lakh rupees of limit is per property. Now, what I mean by this? If I purchase a property worth rupees 60 lakh, there are two buyers. To one, I will pay 30 lakh. To another one, I will pay 30 lakh. To both of them, I am paying below 50. But can I say the property is worth rupees more than or equal to 50 lakh? I need to deduct TDS of both of them on 30 lakh. So that is what this clarification says, that threshold of 50 lakh is combined for all the transferor and transferee. That means the limit is per property. Important one, there is some changes in the TDS rate. There is some changes in TDS rate. But again, the TDS rate ke changes are transitional. And the rates are modified from 1st October 24. Like buyback is applicable from 1st October. This TDS rate is also changing from 1st October. So let me tell you very simple thing. Wherever there is a rate of 5%, from 1st October 24, they have reduced it to 2%. So you have to think in which all the sections the TDS rate are of 5%. First, it was 5% in 194D, insurance commission, 194G, lottery ticket commission, 194H, other commission, 194IB, rent paid by other than triple star, which I call, in a layman language, that is individual HUF, whose last year turnover was not more than 1 crore or 50 lakh, or who is not having business. If pay rent, they have to deduct TDS under 194IB. Similarly, 194M, work professional contract payment paid by individual HUF who is salaried or last year turnover is less than 1 crore or 50 lakh. 194 DA, taxable maturity of life insurance policy more than or equal to 1 lakh. In all these sections, TDS rate are mentioned 5% and it will be 5% if TDS deducted up to 30th September 24. If TDS deducted on or after 1st October 2024, for all these sections, TDS will become 2%. 194D, it has been still capped as 5%. It will become 2% from upcoming financial year. The logic behind this, for all this 5 section, the rate of TDS is mentioned in the Income Tax Act. So budget can change Income Tax Act and hence they have changed the rate. But the TDS rate of 194D always comes in a budget of every year. So budget cannot change the earlier budget. Na? So the budget which came on 23rd July can change Income Tax Act. It cannot change the budget which came on 1st February. And hence the TDS rate of 194D is capped at 5% even prior to 30th September on or after 1st October. It will change from next year. But all this section, now what you have to remember, if TDS deductible up to 30th September, 5%. If TDS deducted on or after 1st October, it will be 2%. See, 194 DA, taxable maturity of LIP, 5%, 1st October say 2%. 194G, lottery ticket commission, 5%, 2%. 194 IB, 5%, 2%. Acha, please understand. In 194 IB, rent of paid by other individual HUF, TDS to be deducted in the last month of the year or last month of the vacancy, that is tenancy, whichever is earlier. But TDS deducted of the entire year. So let's say I stayed in a property, I'm a salaried person, I stayed in a property from April to March. Rent of a month is more than 50,000. TDS is applicable, but can I say TDS to be deducted directly in the March month for the entire year? In all other section, what you will do, I know, up to 30th September, what is the amount you will apply 5%. On or after whatever is the amount, you will apply 2%. But in 194 IB, can I say the entire year ka TDS is deductible on or after 1st October 24, that is in the March month. So on the entire year ka rent, you will apply 2% because the TDS is deductible on or after 1st October 24. Are you understanding what I'm saying? Let's say lottery ticket commission, the threshold is 15,000. It will remain constant for entire year 15,000. Up to 30th September, if I paid lottery ticket commission 20,000, it is more than 15,000. So on 20,000, I will apply 5%. From 1st October, let's say I paid further 10,000. On that 10,000, I will apply 2%. I bifurcated. But what if this is, I'm talking about rent under section 194 IB. Can I say TDS is deductible on or after 1st October 24? And if it is deductible on or after 1st October 24, on that entire amount, I will apply 2%. I don't need to bifurcate. In ICI module, which is earlier uploaded, they have taken a view that no, we have to do proportionate. But now you please download the latest module on Board of Studies portal. They have changed their view. They have changed the answer in one of the illustration of 194 IB. And they have deductible on the entire rent 2% because it is deductible on or after 1st October 24. Similarly, 194M earlier 5%, 1st October onward 2%. I have missed out 194H, other commission, earlier 5%, on or after 1st October 2%. What I have specifically written, 194D, it is still 5%. 2% will be applicable from next financial year. In the last chapter, 115 BAC and alternate minimum tax. As I said, the rates have changed. 3 lakh, 3 lakh to 7 lakh, 7 lakh to 10 lakh, 10 lakh to 12 lakh, 12 lakh to 15 lakh, more than 15 lakh. So if it is up to 15 lakh, tax will be 1 lakh 40,000 and on balance income, it will be 30%. What are the other changes? If you follow 115 BAC, salary ka standard deduction will be 50,000, 75,000. IFOS family pension standard deduction will be 25,000 instead of 15,000. 80 CCD subsection 2 deduction will be replaced to 14% of salary instead of 10% of salary. House property loss cannot be set off against other head nor it can be carry forwarded. Achha, if you follow 115 BAC and your total income is up to 7 lakh, rebate is applicable. What if my total income is 7 lakh and 10,000? Can I say it is very nearer to the threshold? So what I was getting is marginal relief. That let's say if my total income is 7 lakh, as per 115 BSc tax is 0. If my total income is 7 lakh 10,000, can I say what will be the tax applicable? 3 lakh to 7 lakh, 5%, 20,000. 7 lakh to 7 lakh 10,000, it will be 10%, that is 2,000. So basically, 20,000 plus 2,000, tax will be 22,000. Rebate is not applicable because it exceeds 7 lakh. But can I say the difference of income is only 10,000, when the difference of tax is 22,000? How much is difference of tax which is more than difference of income? 12,000. That will be allowed as a marginal relief. And the balance tax will be 10,000. On that 4% size is applicable, 10,400. This I'm talking nothing new. For your attempt also this was applicable. Acha, in surcharge so anyways it was applicable. In case of rebate also, now marginal relief is introduced. But this marginal relief is introduced only if you are talking about 115 BSc. In case of old regime, and if rebate is applicable, marginal relief is not applicable. Now what is the change you know? Now the tax rate have changed now. Always in my notes I give a threshold. So far as 115 BSc is concerned, please remember, if you follow 115 BSc and you have only general rate income, you can check marginal relief up to 7,22,220. So if your total income is up to 7,22,220, marginal relief will come. If it is more than 7,22,220, marginal relief will not come into the picture. Let's take an example. If my total income is, let's say, 7,23,000, on 7 lakh tax will be zero because rebate. If my total income is 7,23,000, can I say the tax will be up to 7 lakh 5%, that is 20,000. On balance 23,000, 10%, that is 2,300. Total will be 22,300. My income increased by 23,000. My tax increased by 22,300. Difference of tax is not more than difference of income. Marginal relief will not be applicable. So please remember this threshold, 722 to 220. Up to this, marginal relief will come if 115 BSc is there. Over and above, it will never come. This is just for your simplification. It is not written in the act. This is just for your simplification. This was whole and sole amendments which are applicable from January 25 to May 25. If any kind of doubt persisting in this particular PDF, in this particular amendment for your examination, I'm always available. All the faculties are always available. You can reach out to me. You can reach out to our helpline number also. We have zoomed out solvings also. You can reach out to me. Many of you are having my contact number. You must be having my Insta ID, CA Aagam Dalal. You can follow on me. You can ask me any kind of doubt which you have. We all are very happy to guide you, to help you till your examination and further after that. Thank you so much. Thank you so much.